Hello and welcome to Blue Chip Now, the podcast that gives you insider access to content that we tailor specifically for our clients. Join us as we break down the markets, debunk the headlines, and keep you ahead of the curve. Let's dive in. Hello and welcome back to another episode of Blue Chip Now. You have Daniel Dusina, Chief Investment Officer.
Matt Mondoux, Senior Financial Advisor.
And we have a nice slate for you all today. So we are going to start off talking about the Federal Reserve and interest rates after a meeting last week. We'll chat through some developments in the U.S. labor market. We want to do a bit of a recap and some commentary on second quarter earnings season, specifically related to big tech. And then round things out talking about the macro landscape, specifically oil and the conflict in the Middle East. And then stay till the end because we are going to try to tie all this together, make some bottom lines, and also point out some of the specific items that we're watching in the very near future. So without further ado, let's talk about the Fed. So Federal Reserve met last week. No decision was made, meaning, there was no change in the baseline level of interest rates. Target Fed funds rate maintained at 3.5 to 3.75%. But what was interesting about this meeting was that the decision was somewhat split in terms of those in favor of maintaining the current level of the Fed funds rate and those that were in favor of increasing the baseline interest rate by 25 basis points. So this decision was split 9-3. It might not seem like a large dispersion, but the fact of the matter is you usually do not get any difference. Usually the FOMC voting members are generally speaking on the same page. I think this is indicative of the challenging environment that the Federal Reserve is facing right now. Inflation is still too high. A lot of this is based on energy prices that have been resultant of conflict in the Middle East. But as Matt will chat through in a moment, you are starting to see some conflicting evidence from the labor market. So if the labor market was kind of running gangbusters while inflation was too high, it would be a fairly easy decision for the Federal Reserve to constrain the economy, meaning hike interest rates. But that is not the case. You have higher inflation and a labor market that's showing some signs of weakness. So you have new Fed Chair Kevin Warsh and the rest of his committee there left in a challenging position. And what that's resulting in is investors questioning, is the next move for interest rates still potentially higher? And if so, when? Or is the economy actually structurally weakening below the surface enough to prevent an actual rate hike? So unfortunately for market participants, the answer kind of remains, we have to wait for the data. And that ultimately is going to bring us to what is probably the biggest story of the last week or two, and that's in the labor market.
Yeah, it seems like this happens every now and then where, the labor market just delivers a really surprising report. And this was certainly that. It showed the labor market, hitting the brakes. So instead of adding roughly 80,000 jobs in July, the economy lost 23,000 jobs. And the unemployment rate actually fell to 4.1%, but the payroll number was dramatically weaker than economists expected. Previous month employment figures were also revised lower, which is also kind of another surprise, right? Whenever you get a weak report and then we look back and we say, actually, things were weaker than we thought they were back then, that's never great either. And the financial markets obviously digested this as a probability that was, reduced on the Fed rate hike side. So that's, great when we think about bad news is good news for the markets, right? Stocks rallied, bonds rallied, the dollar's weaker, gold climbed. Obviously, all these things, play with interest rates and declining interest rates or the prospect of steady or declining interest rates. So, the key takeaway isn't simply the job market's weaker. It's that the market narrative may be changing. So to Daniel's point, what you were alluding to is we kind of had this whole energy spike, energy surge, inflation. And now we're really looking at the labor market saying, whoa, we're getting a completely different story that the Fed has to think about. So this is like the ultimate tug of war.
Right. Yeah, and a couple of points just to add on to that. So Matt mentioned the economy lost 23,000 jobs instead of adding 80,000 in July. And then the prior 2 months, so May and June, instead of being relatively strong months in the labor market, in aggregate, they revised those numbers lower by 100,000 jobs. So this is where, I've come out and said, whether you look at my most recent quarterly edge or appearances on this podcast, it kind of felt like the labor market relative to 6, 9, 12 months ago was on a lot better footing. Mm-hmm. And we had a lot more encouraging data. And all of a sudden, you kind of get the rug ripped out from underneath you. And if you were to zoom out and look at month to month over the last 12 months, the number of jobs that have been added, all of a sudden you kind of see this declining trend line developing. And again, that's just one of the frustrating facets of being an investor is you are kind of beholden to the data. And if that data is actually incorrect, you're trusting government data, and you do run the risk of having these things be updated retroactively. So not overly concerning at this juncture, but that tug of war is going to cause some volatility in the market, in my view. The other thing I wanted to call out is that, Matt mentioned that the unemployment rate actually fell to 4.1%, but it's important to understand that the majority of this move lower in the unemployment rate is not just because more people are able to get jobs. It's actually because there's less people looking for jobs.
Yeah, and I think it's an interesting point, right? I think people hear that and it doesn't make sense. Hey, we lost jobs, but unemployment fell.
Right, and it's been a trend that has developed and actually intensified this year. I think most people should be familiar with the demographic trends that exist in the U.S. today, and that includes retiring baby boomer population. And so what you're seeing reflected in this unemployment rate moving lower is just the simple fact that there's a fair amount of people retiring. So your labor force participation rate is moving down towards levels that we really haven't seen since, I guess, 2020. So this has been a structural challenge since the pandemic. And I do think it makes sense. Again, this is not overly alarming. It's not some doomsday scenario, but I think it's just important that people understand what this data is actually showing you, right? Okay, let's jump over into the equity market a little bit, because we saw first quarter earnings in the U.S. corporate landscape has come out well above expectations. Increase year over year for companies in the S&P 500 about 26%, and that was great. Markets obviously reacted to that, and this is back 3+ months ago. So what that did was set the bar incredibly high for companies when they come out and report second quarter results. And so even with that high bar, results have been pretty darn encouraging. So yes, there has been a lot of investor scrutiny with that high bar, especially around those folks involved in the AI cohort that are spending a boatload of money on building out data centers and the relevant components. But when you look at companies like a Microsoft or like an Amazon, who are both heavily involved in spending money to build out artificial intelligence capacity, they have mature businesses in cloud computing, Microsoft Azure, Amazon Web Services, that are growing 40+% year over year, which is, it's kind of eye-opening when you see those types of figures for businesses that are already massive. And the investor scrutiny that you have seen, let's take Microsoft as a great example. After reporting those results, shares jumped, 15% or so on July 30th. That added $450 billion to its market value in just one day. And that is kind of encapsulating what investors are wrestling with right now. You've got a company like Microsoft that's spending hundreds of billions of dollars this year to build out additional artificial intelligence capacity, but investors still want to see results today, right? And be able to anticipate that these these investments are going to actually be productive. So there was a lot of pessimism around Microsoft coming into that most recent set of results, and that's why you see such a big jump. So the reason I call out these two is just because I think these are two very relevant ones that are reflective of that investor scrutiny. I mean, you are seeing I would say broad-based level of earnings that are over and above analyst estimates. This is not just isolated to the tech sector, to the point where if the current figures hold as they're kind of moving on a trajectory basis today, it will be the best quarter of year-over-year earnings growth since 2021, right when we were coming out of the pandemic. Yes, this does include some one-off items from big businesses, Amazon and Alphabet, but even so, I think it's emblematic of, yes, there are some concerns that are relating to this artificial intelligence build-out from a spending perspective, but to have first quarter year-over-year earnings growth at 26%, and we're tracking above 25% for the second quarter as well. I mean, I think it does give you some intel to maintain that confidence in the market right now and help explain why the U.S. market continues to push toward record highs.
Yeah, I mean, I thought this was interesting too because Amazon and Microsoft had kind of been, I guess, underperforming the rest of their cohort year to date up to that point. Microsoft is still, I think, up 5% year to date, even with that big print, and Amazon's up, I think, roughly 20, but a large amount of that return had come from post earnings. Yep. So it was interesting to see these companies, as you described it, markets were kind of tepid on these businesses, what they're doing, and then ultimately the results, and those earnings reports really, I guess, squashed a lot of investors' concerns, and it took two businesses that were, underperforming the market and actually, turned them positive and, start outperforming the market, which was interesting.
Yeah. So, this level of investor scrutiny is not going to go away anytime soon. And I think that's warranted because, I mean, the last thing you want to see in terms of the health of a market is that investors are just blindly pushing names higher for no real specific reason.
We don't care that we're lighting, hundreds of billions of dollars of CapEx on fire.
Right.
You're right. Yeah, exactly.
Yeah, we're in the show me portion of this whole trade, and I think that's healthy. So again, there is a reason that the U.S. equity market continues to push towards all-time highs, and yes, it's going to be an even higher bar set now for the next quarter, but again, the market will look through that when they smell something that doesn't feel right. That will be reflected in prices, but realistically, it's not going to be surprising to see continued volatility around some of these high-flying names, but I would say net pretty encouraging, at least thus far in the second quarter earnings season.
Yeah, no doubt. So I guess, one of the themes this year has been the AI trade. The other theme's been Iran and the Strait of Hormuz, and we'll talk about that next. So, oil prices have been swinging, I mean, absolutely violently as investors try to figure out the day-to-day, whims of the U.S.-Iran conflict and what's going on with the Strait. We go through these periods of optimism and pessimism, and August 3rd, you saw crude oil fall around 7%. After President Trump held off another attack, and the hopes for deals increase. And that relief doesn't last long. So negotiations over reopening the Strait remained uncertain. Oil bounced back as traders worried that the security of shipping, through this important, energy way is just, we're not sure. Obviously, and then, what goes on in the Strait of Hormuz comes to the U.S. shores by way of gas prices. And higher oil means inflation pressure, and more inflation pressure means, obviously more questions for the Federal Reserve. And this is becoming, again, kind of tying this back, becoming a really tough, needle to thread here with inflation in the job market. So right now, oil is effectively functioning as the live inflation indicator for the markets. And so much of the swing, I would say, in the inflation numbers coming from what are energy prices doing.
Yeah.
So if the Strait of Hormuz can open and there can be a successful deal negotiated, we probably start to look towards the potential for rate cuts. And if not, the economy could be forced to absorb higher interest rates, higher energy in the face of what is ultimately a slowing economy.
It's super frustrating because you can tell in day-to-day market action that investors want to put this behind them. They want to look through any developments in the Middle East right now, unless they are absolutely necessary. So the day-to-day dialogue, for example, that's happening right now between Iran and Oman, because the U.S. is not involved. And it's just the market wants to focus on things that are probably more important right now, AKA the actual company level productivity, what's going on in the U.S. labor market. Is there actually hiring happening or is there not? Because we're getting differing reads. But the fact of the matter is they can't completely ignore it. It's not behind us. There is still meaningful tension that exists. And so as long as that does, your kind of chain reaction will continue to be, if conflict escalates or no negotiations progress, that means higher oil prices, which means potential for higher inflation, which means higher interest rates going to be priced in the market, which can be detrimental to stocks. That's like your typical chain reaction, and we've seen that play out at many, many points through many, many weeks so far this year. So I would say, the number one kind of consideration right now to try to put this all together is really the battle between inflation and economic growth. So we're dealing with higher oil prices. We're seeing that lead to potentially persistent inflation, and that's causing higher bond yields in anticipation for a Fed that will move the baseline interest rates higher. That creates pressure on stocks, and then you get this jobs report that comes out and shows you, well, in addition to dealing with higher prices, we're really not in a position to hire robustly. So what does that all mean? Well, again, we're kind of, as investors, beholden to the data, and the most updated piece of evidence we're going to get this week is with the July inflation report. So the consumer price index, widely utilized as the kind of baseline indicator for inflation, CPI, expected to rise 3.4% year over year. This is off of a year-to-date high of mid-fours after you've seen some reprieve in the energy markets. But here's what the market dilemma is. If inflation comes in soft, investors can kind of conclude that the Fed can stay patient, and that could be good for stocks and bonds. But if inflation comes in above that 3.4% year-over-year number, particularly because of energy prices, then the market is going to have to probably revive the possibility of another rate hike, which bad for bonds, probably bad for stocks, and moves estimates higher for interest rates. So any of that bad news is good news that we got out of that bad jobs report for the month of July, I think that'll probably end up getting unwound. So again, we're kind of just speculating at this point, but what we do know is that we get that data this week, and it will be closely watched, and it wouldn't be surprising to see some volatility as you lead into that report and immediately thereafter.
Well, it's amazing, too. I mean, I haven't even noticed it at the pump. As I'm driving by various gas stations, I'll see 20% or 20 cent differences, day to day. It's pretty amazing to even see the effect that easily.
Yeah. And, again, I think it's more than just one piece of spending, right? So you see higher spending at gas stations. That's been resulting in lower spending elsewhere. Mm-hmm. So, the average person is kind of thinking of this spending as like one pot. And so if you have to, or you're forced to elevate one category, they kind of inherently seem to be pulling back elsewhere. And that was something that was discussed at length through first quarter management earnings reports. And it has come up again, especially in your real consumer-facing pieces of U.S. businesses. So maybe just to recap, walked through interest rate considerations, the Federal Reserve holding rates steady, but some serious disagreement between Federal Open Market Committee voting members, talked through some of the intricacies within the most recent jobs market data, discussed some of our takeaways from the most recent round of earnings specific to big tech and some companies like Microsoft and Amazon. And then we worked into the macro picture and talked about the continued tension that exists between the U.S. and Iran, and tried to put all that together as we start to look at the next major test being the Consumer Price Index, CPI, coming out this week. So plenty to digest, and as we said before, puts the Federal Reserve in a very challenging position in this tug of war.
Yeah, welcome Kevin Warsh.
Good luck. Godspeed. Okay, well, thank you all as always for tuning in for another episode of Blue Chip Now. We look forward to speaking with you again soon.